one story to talk about this morning, and that was a development seen last night with the French election. And as you can probably see, even without knowing the news, you can tell what happened from the first round of the French elections, and that is the worst case averted. So the situation that you might have had neither Macron or Fillon qualifying for the second round did not materialise. Macron coming out as the largest in terms of the results, closely followed by Le Pen, then Fillon, then Mélenchon. This meaning then that both Macron and Le Pen qualify for the second round, and as far as the market is concerned, without being too complacent, this French presidential election is a done deal. That's why the first round was always going to be much more important than the second round vote, which we'll get in about 2 weeks' time. And that's because, given the way that the polls, and now people, I'm sure, will give a bit more credibility going forward because they were pretty much spot on. But the polls and the divergence, a gap between Macron and Le Pen going through to the second round, which we'll have a look at shortly, is so wide it's almost insurmountable. When you're talking about a 30 percentage point difference, when the margin of error was only 6%, or roughly so, for the Brexit vote, it would be an absolutely cataclysmic surprise of that kind of size if Le Pen were to now beat Macron. Hence the market then sees this knee-jerk, quite aggressive reaction in the market. You can see top left, sharp gap higher in Euro-dollar futures last night. The DAX this morning, the Eurex open at 7. Bunds likewise to the downside. S&P, so US futures, following in sympathy with the move higher in European equities and just general sentiment. Gold lower, so reversal of the flight to quality bid that may have been in those assets like the yen and gold last week in preparation for the tail risk associated with the event. Now, the gap ups that you're seeing, to put it in a bit of context, they are aggressive moves, but by no means euphoric. I think that was mentioned in Deutsche Bank's note, and I think that's spot on. This isn't the biggest gap move that I've ever seen, but certainly it eradicates one of the main risks associated with certainly the first half of this year. And it does have some knock-on effects then for what we're looking for going forward, particularly from the ECB this week. So firstly, let's just have a quick recap of what exactly happened by the numbers. And Macron actually was, I think this is probably even slightly better than what some of the average poll of polls was indicating. So 23.87%. Le Pen coming in second, and Fillon only just pipping Mélenchon at just shy of 20% of the vote. So again, one of the most interesting things here was the fact that polls, for the first time in a while, which had lost a lot of credibility, obviously having got things like the EU referendum and Trump-Clinton wrong, were right on the money this time round. Some of the main things here to just be aware of, to put it in some context for the actual election itself. It was the first time that neither of France's mainstream parties have made the presidential runoff. Now, if you're looking at the combined vote share, look how phenomenally low it is for what it is the kind of main staple of politics in France. Obviously, you've got On the Move, Macron's party, which is brand new, and then the far right, which have never actually managed to get past the kind of into any credible position, so to speak. The other chart of note here is that in terms of the National Front, it is actually their best showing. This is pretty much, though, as expected. So this was previous years and eras gone by of the family name, and then Marine Le Pen from 2012 has increased in proportion. We're going from around 18 to 22% or so. So there has been a slight changing of the guard, so to speak, and obviously France, from what has been the last kind of 4, 5 or 8 years, has gone from this massive socialist disappointment, if you like, to go all the way back to leaning quite far right in this instance with Le Pen. The charts that really kind of sum this up then is looking from a currency perspective. Obviously there's the idea of risk on, risk off associated with the unwinding of outside bets that maybe we could have had another kind of populist movement, i.e. the EU skeptic candidates winning through. That didn't materialise. So the euro, fourth spot, obviously is appreciated sharply. Equities likewise in the S&P, and then on the flip reverse, so gold and the yen that we were just mentioning, a bit of unwinding of that flight to quality bid. Elsewhere, some other graphics that's probably worth just quickly recapping once my computer starts to wake up on a Monday morning. And this is looking at risks reversed. So if you remember, we were looking at this very chart on Friday when we were doing the actual rundown, and this was the 1 month risk reversals that spiked up. A lot of people were positioning themselves in implied volatility for a bit of a hedge that either way the market's going to see some substantial potential volatility on the back of particularly the what if scenario. That obviously hasn't materialized, so an aggressive pullback and unwinding of those positions is ongoing since last night. I'll just make this bigger so we don't have to click on it directly. Japan, US stocks bouncing after the election. I mean, we're looking here really at the US election boost that equities had taken, the TOPIX index being the overall kind of composite Asian index, the S&P in the US obviously slightly outperforming, but a decent move and bounce back towards what had been a weakening trend going into some of these big risk events. Likewise then, French vote threatens the rallies for treasuries and gold. Obviously both those products have seen a fairly decent turnaround in recent times. A bit of unwinding possibly of the Trump trade that took place in the last week or two, given the disappointment on the repeal of Obamacare, given what had been some noises towards a delay in regards to him doing his super tax reforms. But this obviously negates that slightly and eradicates some of that market uncertainty. Looking more specifically, this is probably the type of headlines that you'll read about. If you're looking at the actual CAC 40, the stock index in France, you can see here just where we're tracking at the moment. You're going to have to go back towards, well, you're looking really 2007. So this is really before the move that came pre-financial crisis and the subprime years, when we hit that initial low before the kind of rescue team of the ECB started to step in with other global central banks. But we're right up there, multi-year highs in the CAC this morning. If you were looking at individual equity performance, so here you can see the European indices, CAC 40 leading the way. Who do you think is the biggest beneficiary from a European index point of view from what's happened from the weekend? Who is the other country that most people have the biggest concern about from a political standpoint? Now, Netherlands has passed, Britain has passed. What other European country is it that people are really fretting about in the future? Aside from Germany's federal elections, John P. spot on Italy. Italy is the big one that carries a huge risk surrounding the five-star movement and populist movement. And so there's a lot of read across between sentiment specifically for Italy and also the CAC 40 performance today. Hence the reason why you can see that those two indices are outperforming things like the DAX, so to speak. Well, I don't think the DAX is actually updated on this chart, to be honest with you, but it's Italian stock index second performer behind the CAC. Looking at the actual individual stock performers, quite clear to see then that the bank stocks, they were up around 10% at the open. They've come off slightly, but SocGen 8, Credit Ag 7, BNP 7. These are probably the most kind of sensitive to the situation. Keep in mind that they had been rallying into this before a slight nervousness dip at the end of last week, but a firm recovery on track, and most of all these companies here helping support that pretty decent gain seen in around 3.5% in the index. Looking forward then, what does this mean for the second round? And this is quite a good graphic that I saw this morning that I think helps put this into a bit more perspective. And what you're looking at here, this is a table about the second round, so Macron, Le Pen, and there's various assumptions. This is the head economist at one of the world's largest asset managers, Pictet. And what he's looking at here is he's made a table about vote transfers on assumption. And so obviously Le Pen's backers will continue to back Le Pen, Macron will continue to back Macron 100%. The question being then is abstentions, people who decide that, you know what, I don't want to vote, maybe my candidate didn't go through and I feel that strongly and tied to that individual and party, I don't want to now move my vote over to another political party. So that makes up a slightly smaller proportion, but a fairly significant one. Certainly you can understand people like Mélenchon's party, where he had such far-reaching and extreme reforms on the leftist side, that if that, you know, you probably would not be anywhere close to being satisfied by voting for someone like Macron. So a 40% abstention rate is kind of explainable from that point of view. Whereas Hamon, or Amon, as I need to correctly pronounce his name, as Philippe always tells me off, he is much smaller at 20%, given the fact that he's not so far left, so moving centre left is a bit more of an easier pill to swallow for that voting public of that political view. What you can see though is where the other votes are going to come to help support Macron, and why then he has such a large advantage going into this second round, and why the markets foresee this as being a fairly clean-cut deal that he will now win the presidency. If you think about the centre-leaning candidate, centre-right, Fillon, about 30% might go further to the far right, a slightly larger 40% are likely to prefer the more centrist view. Mélenchon, no way they're going to vote far right. The only probably thing that they might agree on is the idea about being skeptics of the EU, but otherwise every other policy, there's no way they're going to back the National Front, or only a small proportion will. However, some 50% are likely still to want to voice their opinion, and therefore will move to Macron's camp. And then Benoît Hamon, 5% again to Le Pen, 75% likely to go to Macron. So this is just pure mathematics now, adding up, and you can see why Macron is seen as such a favourable candidate then to outperform Le Pen going forward. Okay, so some quite interesting things there to take away, and certainly the turnout rate went against the likes of the more traditional parties, so Fillon's Republicans and the National Front, even that Marine Le Pen support as well, even though she qualified. The turnout was fairly similar to what we've had on previous occasions. The lower the turnout would have been more beneficial for those older parties, but that did not materialise. So that might have been another play as well. Okay, let's have a quick look at some of the other things to be aware of that's come out in the press from the weekend. Some of you might have caught this. This obviously isn't so much in focus yesterday as was the French situation, but certainly the Conservatives continue to push away in the Westminster voting intentions from some of the latest polls. Comres yesterday, Conservatives now a further 4, so now at 50. Lib Dems still unmoved at 11. UKIP continuing to lose ground. So the Conservatives now, this is going up to the highest levels than we've seen in many, many years in terms of support going into that June 8th election. One of the other things that we're looking out for this week, which we'll get in the second half of the week, is the ECB interest rate decision and press conference. Obviously there's a lot of question marks now on what exactly does this mean, given that one of the biggest threats potentially to restricting the ECB from being more hawkish, and by that I mean raising the deposit rate whilst ongoing QE, or at least hinting toward language to suggest that they're thinking that way, an unwinding, if you like, of accommodative period of policy. Does this now take sharper focus, and does this now give the ability for the ECB to become mildly hawkish when they have their press conference in particular and issue of their statement on the second half of this week. So this is definitely something we're looking out for. FT looking at the same thing this morning. They're meeting on Thursday. It'll be the first meeting since the central bank scaled down its asset purchase program, so don't forget that. It was the beginning of April where the actual kicking, if you like, of the reduction that they previously announced several months ago from 80 to 60, that's now underway, so he's going to be questioned on that. Inflation is really the main thing, nudged up above the ECB's 2% target in February for the first time in 4 years. And now that the election risk, one of the biggest events for Europe, has moved away, and it seems set to now not be an issue, does this mean that the ECB can get back to kind of tactic and focus on their policy manoeuvres going forward? So really very much we focus on euro area reflation risks this summer. But Deutsche Bank do note this morning that is this meeting too early for there to be too much change in language or emphasis outside of acknowledgement of an improving outlook. I think that's pretty much a sensible assessment of the situation. They're probably likely to sound fairly upbeat, but I doubt that they'll sound outright hawkish and start talking about rate rising kind of outright, so to speak. One of the other big things from the weekend, and certainly might get more attention when the US come in, is this guy, Donald Trump. He tweeted on Saturday, don't know if any of you saw that, big tax reform and tax reduction will be announced next Wednesday. So he continues to make this kind of quite brash commentary about promising a big announcement next week on overhauling the US tax code, according to a top campaign pledge. Obviously, he followed up with that tweet as well. Will be consistent with the broad principles and priorities on his administration. The one thing, probably the reason why Trump is making this kind of noise at the moment is, well, for one, he's disappointed thus far on what he has been able to achieve. Two, this Friday marks the deadline to avoid a government shutdown and agree a new spending plan. And then three, Saturday coming marks Trump's first 100 days in office. So there's a lot riding on him really putting a rubber stamp on his authority and to what he has achieved, and he really needs to make some movement on this issue about fiscal reform, tax in particular, as soon as possible. One would think there's only so much the market can take about being disappointed by a guy that has a big bark but no bite. And so he's going to have to prove this at some point or another. And so the coming week or so is going to be really important for Trump, and this idea about a fiscal stimulus is forthcoming. If that comes in combination, if he does deliver, then obviously if you're looking at the markets at the moment, there is plenty of optimism, at least in the short term. You know, Brexit is a much bigger play. So the election, I don't think it's going to really have too much of a sway to dampen European equity sentiment. If you look at the DAX this morning, we're just edging up to fresh highs again. If we look slightly longer term, this is a 350-minute candlestick. Upside here, you've got 12,411 spot 5 just to keep an eye on. That was the high print that we had in the futures back at the beginning of April. We are just short of that at the moment, so I'd be keeping an eye on that level. Slightly longer dated, if I put the chart out on a daily continuation, obviously those highs that we had at the beginning of April, that was when we hit resistance. That's kind of that double top that we've had from way back in 2015 to where we are now. So this is a really important level. If we get a break on that, does that then act as the next kind of platform for an additional move higher? The only caveat to that may be if the ECB felt it was warranted as soon as now to get more hawkish, because equities tend to react negatively when the punch bowl, if you like, starts to get removed, that being easier monetary policy. Likewise, let's have a quick look elsewhere at the euro currency. After the quite sharp gap up that we had last night, we actually declined through much of early Asian trade before stabilizing. If we take a look at slightly longer dated, I mean, we only got to go back in the futures to the end of March on the 27th. We were up at 109.49, so by no means is this a a monumental gap higher in prices. So maybe if we start to get any type of headway on that 109, then I'd be looking at that level. The only thing is that counter to this move, if Trump can deliver with a forceful and timely tax stimulus, then that will probably likely spur some strength into the dollar, and then the Trump trade is kind of back on short term, or Trumpflation, and then that might negate the ability for this pair to move considerably higher. I mean, looking where we are though, certainly for 2017 and also encapsulating December, technically this is the top end of that range that was kind of being defined over the last, I'd say, 4.5 months or so. So any movement above this 109.48, certainly, I mean, that's the US election. That was what was the catalyst for the real punch lower. But a break above there, and certainly 110. But then, as we saw previously, one of the main reasons why the market came off here quite aggressively in euro dollar was because that was when the ECB sources started to come out, playing down the kind of idea that the ECB were anywhere near turning hawkish. Market shouldn't get too run away with itself about this idea of inflation. At the time, inflation did start to tail off slightly in those readings when we got to those original highs. Remember, the ECB doesn't want the currency too high, because then that starts to have negative connotations, particularly in the lights of, say, export names and so on. And so as much as these politicians and central bankers say they don't manipulate the currency, I'm afraid that they do, whether intentionally or not. And so some interesting levels to be aware of there. Just as I've been talking, German IFO's just come out, 112.9. That's broadly in line with expectations of 112.5. So not too much reaction seen there, and probably the market still more in a mode of digestion of what's happened in France overnight. Okay, quick look at the calendar then for today. IFO's just come out and just gone. So otherwise, the economic calendar for today is extremely quiet. The Chicago Fed National Activity Index is not a big deal for the markets. I'd probably rank that down at tier 3. So don't need to really factor that in terms of an influential release for market prices. But you do have Kashkari speaking around cash close. So calendar very quiet. As such, I'd probably be more mindful of the market is fairly quiet at the moment. Despite this kind of aggressive moves that you're looking at in your chart, most of that happened at the reopening of trade from overnight. What might take now this market to make the next concerted move one way or the other, either a move back down to reverse and gap close or gap fill some of the moves that we've had, or continuation of the sentiment, which is positive from the Macron-Le Pen going through situation, is that when the US come in, how do they start to interpret the information? Because the US as well has a dual fold reaction from the commentary from Trump as well at the weekend. So do they or do they not believe his ability on this this kind of phenomenal tax deal that he keeps stressing that he'll deliver? So I would just be a little bit more managed about what you're going to expect to get out of the next couple of hours. It might take now until the US start to come into the market before we start to see a more bigger move in the market, now that that had already occurred from the overnight session. Okay, going to wrap it up there. But overall, European bank stocks, biggest jump in 12 months. Macron through, it averts worst case scenario for Europe. This is a big kind of sentiment play for what it might mean then for the likes of the ECB and their policy going forward, for Italy's fate in its potential political, I'd say, election that may happen this year. And then obviously you've got the German one at the end of the year. So risk on generally, an unwinding of a lot of the stress and nervousness that we're seeing in the market yesterday. But again, I would say you've just got to be a little bit objective about what you're seeing, which is now things have quietened down quite a bit. And so maybe when US come in, it might offer us some more opportunity. Okay guys, have a good session, and we'll see you in the chat room. Thank you.